Marks & Spencer's shares rose 5% on results day, yet the company just reported a 25% drop in revenue and a 24% fall in adjusted pre-tax profit. That gap between the headline numbers and the market reaction is the question this analysis is built around, because the answer to it determines whether the current share price is a recovery entry or a value trap in disguise. The consensus reading is simple. The cyberattack damage is now quantified. It came in below the worst fears, and the company is moving forward. That reading is not wrong, but it is incomplete in a way that changes the allocation decision. The profit hit landed at £324 million in trading profit in the first half alone. M&S recouped only a third of its £300 million in lost sales through insurance. The number that matters is not the size of the hit, it is that the recovery to pre-attack profit levels will require hitting a £603 million pre-tax profit forecast in the current year against a base that was already being stressed by UK clothing market softness before the attack happened. Barclays projects a rebound to approximately £920 million in pre-tax profit for the new financial year, which would represent a recovery beyond the pre-attack baseline. But Barclays also named 3 specific conditions attached to that number: inflation staying contained, fashion data stabilizing, and political uncertainty not escalating. All 3 of those conditions are currently unresolved. The CEO's own language is a countersignal that most coverage missed. Stuart Machin described the dividend increase as conservative, reflecting the current investment phase. A management team that calls its own dividend conservative is flagging that the investment demands ahead are not yet fully priced by the market. The dividend raise is not a signal of confidence, it is a holding pattern while capital is being committed elsewhere. What the 5% pop actually reflects is relief that the cyberattack chapter has a closing date. What it does not reflect is what the chapter that opens next costs.
The capital commitment that follows the cyberattack recovery is not a coincidence of timing. It is the strategic logic that the attack forced into the open. M&S spent £66 million acquiring a 437,000 square foot warehouse from ASOS and simultaneously began construction on a £340 million food distribution center in Northamptonshire, its largest ever investment in the food division. Together, that is over £400 million in capex erected at a single strategic objective: transforming M&S Food from a premium convenience destination into a genuine weekly shop competitor. The food division already accounts for 54% of M&S revenues, and grocery sales grew 5.6% year-on-year in the most recent trading update. The company reached a record 4% grocery market share in November. That number matters because the next target is identifiable. Waitrose holds 4.6% market share. The gap is measurable, and the infrastructure bet is explicitly sized to close it. Here is the point most coverage has not examined. The cyberattack did not just damage M&S, it revealed exactly where the structural weakness in the food business sat. Empty shelves and a 12-week website shutdown were not random consequences. They were the direct result of a distribution and logistics infrastructure that was not built for the volume M&S Food was being asked to carry. The £400 million is not opportunistic expansion, it is remediation of a known fragility, packaged as growth. That reframing has a direct implication for how investors should read the capex. A company investing £400 million to close a logistics gap it did not fully understand it had is a different risk proposition from a company investing £400 million to capture incremental market share. The former creates a capital overhang that earns its return only if the execution is clean, and M&S just spent a year demonstrating that its supply chain execution under stress is imperfect. Net cash on the balance sheet stands at £338.2 million, excluding lease liabilities. The £400 million commitment exceeds that cash position, which means the food infrastructure program is not self-funded from current reserves. It requires the profit recovery to materialize on schedule. The prior thesis on Marks & Spencer was a steady-state UK retail compounder, durable brand, improving clothing margins, food as a high-quality growth kicker. That thesis assumed the capital intensity of the business was stable. The £400 million commitment breaks that assumption, and the question the recovery narrative does not answer is how long the elevated capex phase runs before the food investment begins returning capital rather than consuming it.
The food infrastructure bet lands at precisely the moment when the profitability of the food business itself is being challenged from outside the company's control. The UK government is pushing supermarkets toward voluntary price caps on bread, eggs, and milk. Stuart Machin's response was direct. He called the proposal completely preposterous and stated that M&S is already making a loss on basic foods, including milk, bread, and bananas. That statement is not rhetoric. It is a disclosure that the food business model at the commodity end of the range is already margin negative, and any regulatory pressure to extend or formalize those prices would force a strategic recalculation. The Bank of England Governor Andrew Bailey told MPs that centrally controlling household essential prices is not a sustainable thing in the long run. MPC member Swati Dhingra warned that price controls rarely worked. The weight of institutional opposition suggests the price cap does not become binding policy, but the process of negotiating around it and the government's use of packaging tax relief and regulatory concessions as inducements means M&S's food division is now operating inside a regulatory negotiation it did not budget for. This is where the Iran war enters as a compounding factor. Food inflation accelerated to 3.7% last month. The Iran conflict is driving up fertilizer, raw ingredient, and transport costs across the entire sector. The government's tariff suspension on foods like biscuits, chocolate, and nuts was estimated to save shoppers between £230 million and £370 million per year, a number the British Retail Consortium described as barely touching the sides of the cost pressures retailers actually face. The risk structure here is not that M&S loses the price cap negotiation. The risk is that the regulatory and inflationary environment raises the return threshold the £400 million food infrastructure investment must clear. A distribution center built to capture the weekly shop at Waitrose level margins is a different investment from one built to compete in an environment where the government is actively attempting to compress food retail margins across the sector. The threshold that matters is this: if M&S Foods' operating margin compresses by even a modest amount under combined inflationary and regulatory pressure, the payback period on £340 million of distribution infrastructure extends materially, and that extension falls directly on the holding period assumption embedded in the current price. Marks & Spencer traded at a trailing price-to-earnings ratio of 14.2 on an adjusted basis at results, with analysts projecting a forward ratio of 10.4 for 2026-27. That compression in the implied multiple assumes the profit recovery arrives clean and on schedule. The regulatory ceiling introduces a scenario where the recovery arrives, but arrives into a food margin environment that is structurally tighter than the one the £400 million bet was originally underwritten against.
The allocation question that M&S's results force is not whether the company recovers. The operational evidence suggests it does. The question is whether the recovery is priced efficiently relative to what else the same capital can buy in UK retail. Tesco's share price has risen 69% over the past 3 years and now sits near a 13-year high at 454p. The city's average 12-month price target on Tesco is 517p, implying further upside. Tesco's forward dividend yield stands at 3.45%. Tesco is also navigating the same Iran war food inflation environment, but from a position of established weekly shop dominance. It is not spending £400 million to build the infrastructure that would make it a weekly shop competitor. It already is one. M&S sits 11% below its price 1 year ago, at 317p, against Tesco near multi-year highs. That gap looks like a relative value opportunity, and in a clean recovery scenario, it is. But the gap has a structural explanation that the recovery narrative does not dissolve. M&S is in a capital deployment phase that Tesco completed years ago. Buying M&S now means funding the construction of the logistics capability that Tesco already operates, while Tesco's capital is being returned to shareholders through dividends and buybacks. Next presents a different dimension of the same comparison. M&S's clothing and home business is the segment where the pre-attack compounder thesis had its strongest footing: improving margins, credible online growth, brand rehabilitation. Next has executed a cleaner version of that story with less capital intensity and is trading at a premium that reflects it. The clothing market softness in the March quarter that AJ Bell flagged hit both companies, but Next's exposure to that softness sits inside a business with no equivalent infrastructure overhang. The holding period implication runs as follows. At a forecast price to earnings of 10.4 for 2026-27, M&S is cheap if the profit recovery to $920 million arrives on schedule and food margins hold. The trigger that confirms or denies that scenario is not the next trading update. It is the point at which the Northamptonshire distribution center becomes operational and its volume throughput becomes visible in the food division's margin line. That is a 2027 story embedded in a 2026 valuation. Investors who bought M&S 5 years ago are sitting on a 120% gain. The question that gain does not answer is whether the next 120% requires the same holding period or a longer one with higher capex drag and a less certain margin environment to deliver a return that Tesco can approximate with less execution risk and a dividend that pays while waiting. The dividend M&S just raised to 4.2p per share, with the board's own characterization of it as conservative, is the checkoff detail the market should hold against the profit recovery timeline. If the $920 million profit recovery materializes and the food infrastructure begins generating the weekly shop volume it was built for, that dividend grows, and the conservative characterization becomes a retrospective understatement. If the capex overhang extends and the regulatory environment tightens food margins, that same conservative characterization turns out to have been a warning, one that was visible in the results announcement and legible to anyone who noticed that management chose that particular word. Every day after the close, we publish a market wrap and key issue analysis. Subscribe to the channel.